Right, let's work through a few problems related to bonds. These are long-term liabilities. Bonds are another way for a company to raise cash when it's needed for operating purposes. Um, so looking at this first one, the balance sheet for Focus Consulting reports the following information. We have bonds payable less the discount on bonds payable to get the current carrying value of the bonds. The company is deciding to redeem these bonds at 103 after paying semi-annual interest. What this means is that they are going to pay 1.03 or 103% of their face value. They're going to redeem them or pay them off, buy those bonds back from the bond holders. So the first thing we need to do is figure out what journal entry, well, I shouldn't say the first thing, but what we need to do is record the journal entry when they redeem these bonds. So if they are paying off this liability, we need to debit the liability because it's being paid off. So we will debit bonds payable to record the payoff or the decrease of the liability. Then we are going to figure out how much cash they need to pay. If they are paying cash of 1.03 of their face value, it means they will be paying, move this over here so you can see, 103% or 1.03 times the face value of the bonds. They will be paying cash of $1,854,000. So we will credit cash for $1,854,000. We are debiting the liability for $1,008,000, crediting cash for $1,854,000. When we pay off that liability, and I'm not sure why this is, there we go. When we pay off the liability, we not only need to get rid of the bond payable liability, but if these bonds are gone, we no longer need the discount in here. So the discount needs to be credited to get rid of its balance. So we are debiting bonds payable, crediting the discount, and crediting cash for $1,854,000. Essentially what we are doing is paying $1,854,000 for a liability with a carrying value of $1,674,000. We are paying more cash than what the liability is for. And the reason we're having to pay more than what the carrying value of the liability is because we are buying these bonds back early before they mature. And so bond holders who had expected to hold onto these bonds and receive interest through the end of the life of the bonds won't receive that interest. So ultimately what we have to do is pay a little bit more than what the carrying value of the bonds are. So the carrying value is $1,674,000. The difference between that and the cash that we're being paid is $180,000. So you can't see it here, but this is recording a bond redemption loss. Let me see. There we go. Loss on bond redemption. I'm not sure why these little screens will not show us the full account. I apologize for that. So this loss, remember, losses are just like expenses. It will cause our income to go down for the year. We incurred a loss to redeem the bonds. The other way you can calculate the amount of the loss is to make your journal entry balance. Before the loss is recorded, our total debits are 1.8 million. And if I add up my credits, 1,854,000 plus 126. Currently, my credits are 1,980,000 in my journal entry. My debits are 1.8 million. The difference between my debits and credits are 180,000. So I know I need to debit that journal entry to make it balance, and that is a loss. Okay. All right, so hopefully that makes sense. Moving on to this next problem. This is exercise 15-18. This problem is having us work with, let me make this a little bit smaller. There we go. Get it all on one screen. Issuing bonds. Okay. So this company issued 280,000 8% 20-year bonds on January 1st of 2012, and they issued them at 103, which means they were issued at 103% of their face value. Interest will be paid semi-annually, twice a year, on July 1st and January 1st. This company uses a straight line amortization for the bond premium or the discount. We will prepare the journal entries. The first entry we need to record is when these bonds are issued. When we sell these bonds, we are selling them for 103%. I need to figure out how much I can sell them for. I will be selling them for 103% of their face value. 280,000 times 1.03. I will sell them for $288,400. On January 1st, when they are sold, I will debit cash for $288,400. When I sell those bonds, I have to record the liability. I have a liability to pay off those bonds in 20 years. I will credit the liability for $280,000. The difference between the amount that I sold them for and the liability is $8,400. I sold them for more than what they will be paying off. I am going to record a credit of $8,400 as a premium on bonds. I sold them at a premium. I sold them for more than what the liability will be paid back. As was discussed in the book and in the mini lecture videos, the premium. Why would a company issue bonds for more than what they pay back? Why would investors be willing to pay $8,400 more than what the liability will pay? Well, it has to do with the interest rate. These bonds are offering to pay interest every 6 months for 20 years. Investors could buy these bonds and get an 8% interest, or they could look at other investments currently available on the market. Other investments currently available on the market might be paying a lower rate of interest. So investors would be more interested in paying a little bit more for these bonds to get a better interest return on their investment. Okay, so that's why bonds would be issued at a premium. All right, that was January 1st issuance of the bonds. The payment of interest and premium amortization on July 1st, 2012. Assume that interest was not accrued on June 30th. Okay, so that was January 1st when the bonds were issued. 6 months have rolled past. 6 months since the bonds were issued. The bonds are paying interest every 6 months. The first interest payment is due to bondholders on July 1st. So on July 1st, we need to record how much interest should be paid to the bondholders. The bondholders were told they would be paid 8% interest based on the face value of the bonds. So if we take the face value of $280,000, multiply it by the stated interest rate of 8%. If I stopped calculating there, that would give me interest for a full year. We are not paying interest for a full year. We are only paying interest for 6 months. So I multiply that annual interest rate times 1/2 to calculate the amount of interest that will be paid for the 6-month period. We need to pay cash of $11,200 to bondholders for their interest payment. Thus, on July 1st, we will credit cash for $11,200. We also need to record the interest expense for the interest that we just paid. The interest expense when a bond is issued at a premium or a discount will not be the same as the actual cash paid to the bondholders. And that's because we will be amortizing this premium. That premium of $8,400 means we borrowed more cash than what we have to pay back. Over the life of the bonds, we are paying less to borrow that money. As we spread that premium, amortize it over the life of the bonds, we will be decreasing our interest expense. Thus, if I take the $8,400 premium and divided by the number of interest periods that I have to spread it over. These are 20-year bonds that pay interest twice a year, so there will be 40 interest periods. Thus, I have 40 interest periods to spread the premium over. That means when I make my first interest payment, I pay cash of $11,200 to the bondholders. I will decrease this premium by the amount of amortization of $210. So I am decreasing the premium on bonds payable with a debit. The amount of interest expense that I record is going to be the difference between the cash paid less how much of my interest expense is reduced because I borrowed more than what I have to pay back. I'm reducing the cost of my borrowing. So my interest expense will only be $10,990, which is the $11,200 minus $210, $10,990. Okay. All right, on December 31st of 2012, we need to make another interest payment to the bondholders. Notice that I should say we need to make another interest payment, but the next payment isn't due until January 1st. As of December 31st, 2012, the end of the accounting period, we need to record the interest expense for that next 6-month period that falls within that year. And that interest will actually be paid the next day on the 1st when it's due. Let me go ahead and get this all into one page so it's easier for you to view. Okay. That means on December 31st, we are going to record the interest, accrue it, that will be paid the next day. Just as we did before, we are making an interest payment of $11,200. So we will credit interest payable. We're not crediting cash because we will pay it on January 1st, the next day. But here we are just recording the amount that we owe. We have to decrease the premium another $210, and that decreases our interest expense $10,990. This interest payment journal entry will be recorded every 6 months for 20 years. With the straight line amortization, it's the same journal entry for the interest payment every interest period over the life of the bonds. 20-year bonds, we will make this payment 40 times. With every interest payment, we are decreasing that premium a little bit. So when we get to the end of the life of the bonds, there will be no more premium recorded because the premium we recorded when we issue the bonds will have been recorded as interest or amortized into interest expense over the life of the bonds. Okay, that means on the maturity date of the bonds, which is the last entry they want us to prepare, we are going to assume that we already made the last interest payment. The last thing we need to do is just pay off the bonds. They have matured. The bondholders are expecting their repayment of the amount that they were promised. Thus, the only thing we need to do is just pay off the liability we recorded back when the bonds were issued. And that is simply to take a debit to the bonds payable to decrease the liability and credit cash. Okay. Let's walk through this example for a bond. The difference will be the last problem we did was a bond issued at a premium. This one will be a bond issued at a discount. So Cahill Company is issuing $496,000, 11% 10-year bonds. That means these bonds are promising to pay $496,000 along with 11% interest every 6 months over their life for 10 years. In 10 years, those bonds will pay back the $496. They are issued on December 31st of 2011, and the issue price is given to us of $491.40. Interest is payable June 30th, December 31st. The company uses a straight line method to amortize the bond premium or discount. All right, first journal entry is to record the issuance of the bonds. We were already told that the issue price is $491.40. Thus, when we issue them, we will receive cash of $491,040. The liability we record when the bonds are issued is the $496,000, or the amount these bonds will pay in 10 years. The difference between the issue price of $491.40 and the face value of the bonds, there's a difference there of $4,960. They are being issued for less than what they will be paying back. These bonds had been discounted. They were sold for less than the liability will pay back. We put them on sale. We discounted them. We will record the debit in the discount on bonds payable. Then, in 6 months, on June 30th of 2012, first interest payment is due to the bondholders. Interest is payable semi-annually. Let's figure out how much the bonds will pay. We will multiply the face value of the bonds times the stated interest rate. 496 times 11% would give us a full year's worth of interest. We are only paying interest for half of a year. That means the amount of our interest payment for half of a year for 6 months is $27,280. Thus, on June 30th, we will credit cash for $27,280. The interest expense that we record is going to not only include the cash that we paid, but we also have to amortize that discount. We have a discount of $4,960. We are going to spread that out over all of the interest periods. Take the amount of the discount, divide by 20 interest periods. Why 20? Because they are 10-year bonds, paying interest twice a year. That means there are 20 interest periods. Thus, we will be recording $248 of the discount amortization. Now, a discount will cause the amount of interest expense we record with every interest period to be higher than the cash paid to bondholders. Why? Because when you think about it, a discount represents an additional cost of borrowing the money over and above the interest that we pay to the bondholders, because we borrowed less than what we have to pay back. So part of our interest expense is going to be the cash paid to bondholders, but we are also going to add the amortization of the discount, or the little bit of the discount that is added to our interest expense, resulting in an interest expense of $27,528, which is the cash paid plus the interest discount amortization to get to our total interest expense. Okay. 6 months later, another interest payment is due to the bondholders. It will involve another cash payment of $27,280. That doesn't change. It will involve another amortization of $248 of the discount on bonds payable, giving us total interest expense to record on December 31st of 2012 of $27,528. And this journal entry would be recorded 20 times, every 6 months for 10 years, or 20 interest payments. When we get to the maturity of the bonds, 10 years later, after our last interest payment is made, we would pay off of the bonds. The payoff of the bonds would just be a debit to the liability to pay it off, and credit cash for paying off the liability. Right. This last exercise is going to have us working with a different long-term liability, and that is a mortgage. Okay. Bondorf Incorporated issues a $624,881 12% 10-year mortgage note on December 31st of 2012. They are obtaining financing for a new building. So essentially they took out a mortgage to buy the building. Terms provide for semi-annual installment payments of $50,480. So whereas most of us end up paying our mortgage monthly, they have set it up to make semi-annual installment payments. In other words, they're only paying twice a year. So we are first going to prepare the journal entry to record the mortgage loan on December 31st, and then the first two installment payments. So the first thing that happened on December 31st, essentially the company received cash of $624,881, used that to buy the building, and then they credit their liability mortgage payable for $624,881. Okay, incurring a liability. Essentially, it almost looks like they're borrowing cash. They would turn around and use that cash to pay whoever they're buying the building from. Let's see. Then in 6 months, when they make their first semi-annual installment payment, they will be crediting cash for the amount of the agreed upon payment, $54,480. So credit cash for $54,480. We need to figure out how much of that payment is going to help reduce the liability, the mortgage payable, and how much of that payment will be recorded as interest expense. Just like with us, when we make house payments, our mortgage payment is paying off not only the mortgage liability itself, the debt, but we're also making interest payments. The way we figure out how to break up the payment between principal or mortgage and interest is to take the balance of the loan, the balance of the debt. The debt is $624,881 when we go to make our first payment. We multiply it by the interest rate for the debt. This has a 12% interest rate. So if we take the amount of the liability times 12%, that would give us the interest on that debt for a full year. We are going to multiply it by the fraction of the year for which we are calculating interest, 6/12 or half of a year, 1/2. When I multiply that out, the interest expense that is owed for that 6-month period is $37,493. I will debit interest expense for $37,493. I am making a payment of $54,480. Of that payment, $493 is interest. That means the remaining portion of the payment, $16,987, will decrease the liability, brings it down. So we're debiting the liability to decrease it. Okay, that was the first 6-month payment. Let's record the payment for the second 6-month period. It is now December 31st, and we need to record the second interest payment. Again, we're making another payment of cash of $54,480. The cash payment stays the same with the mortgage. We need to break that out across interest and liability. So what we need to do is figure out what was the amount of the debt for that 6-month period we are making a payment for. We are paying July 1st through December 31st. Remember, in June, we decreased the liability $16,987. So the liability was $881, and we paid off $16,987. So the amount of debt that we've had since the last interest payment, last mortgage payment, is $607,894. We will use the $607,894, multiply it by the interest rate on the debt for half of a year. Of the $54,480, $36,474 is going towards interest, and the difference between the 54,480 payment and how much of it is going to interest will be the amount that we decrease the debt, decrease the liability with a debit. Okay. What you're going to see is with each successive mortgage payment, the amount that is being paid to interest will go down, and the amount going towards the debt itself goes up. And the same concept can kind of hold true with car payments. So if you want to apply this to your personal life, some of you may not have a mortgage yet, but when you're talking about a mortgage or a car loan payment, the more you pay up front early in the life of the loan, the quicker the debt will go down and the quicker you will be paying less and less interest. Okay. All right. Let me know if you have any questions.